little time talking about the fundamentals of accounting, specifically the chart of account and helping you run your business a lot easier. In 2015, I was on the verge of bankruptcy. After giving 20 years of my life to corporate finance, I was left alone, broke, and unable to get a job. I'd done everything I was supposed to. Went to school, got a job, and climbed the corporate ladder, but it wasn't enough. But I didn't give up. I picked myself up, I battled back. I partnered with a mentor and learned how to get corporate accounting clients. 7 years later, I made $510,000 in 2022 from my bookkeeping/CFO business and the investments I made along the way. Now, I show others how to do the same. Hi, everyone. Sharon from Virtual Accounting Strategies here. A little bit about myself. I'm a CMA, MBA, and a QuickBooks Pro advisor, in addition to being in the accounting and finance field for over 25 years. Today, we're going to spend a little time talking about the fundamentals of accounting, specifically the chart of account, and helping you run your business a lot easier. Trust me, you're going to want to watch this one all the way through. If you want to do your chart of accounts right, you'll be able to keep your accounting error-free and fairly straightforward. Oh, before I forget, please subscribe to our channel. Moving on, the chart of accounts is all about being accurate. It's like a balancing act, making sense, making sure that assets and liabilities match up. It's all about creating an accurate picture of your business's financial standing. It can be tricky to do. However, it's become a lot easier thanks to accounting software like QuickBooks. To put it simply, the chart of accounts is the index of all the accounts in the general ledger of a business. It includes all the account numbers and names that are relevant to your business. The entries in the chart of accounts are then used to produce profit and loss statements and balance sheets. In the standard chart of accounts, there are primarily 5 groups: assets, liabilities, equity, income, and expense accounts. Now, let's look at each one of these groups to explain what's included. Anything of value that your business owns becomes aligned in the assets. Asset accounts are part of the balance sheet and usually have a debit balance. I say usually because there are exceptions, but we'll cover that in another video. So this includes liquid assets such as money in the bank, accounts receivable. Other types of assets are like fixed assets like furniture and fixtures, property, vehicles, or even inventory. Also part of the balance sheet are liability accounts. Liabilities usually have a credit balance and include anything the business owes to someone else, like bank loans, mortgages, or bills to be paid. The third part of the balance sheet are equity accounts. Equity is also known as shareholders' equity. You can say that equity is the net value of a business. It's the amount received by the shareholders if we liquidate all the company assets and repay all the debt. In short, equity measures the net worth of a company, or what's left over after deducting all the liabilities from the assets. Next up, let's look at all the income accounts, or the money in. Many business owners try to keep income accounts simple with 2 categories: goods and services. But this doesn't always give you a full picture of how your business operates. With QuickBooks, you can split up your income lines into subcategories or of each product or service your business offers. It's then easier to identify which parts of the business generates the most revenue and make decisions accordingly. And finally, let's talk about expense accounts. These accounts show money that's being spent to operate your business. When creating your expense accounts, again, consider subcategories. For instance, if you use multiple shippers to get your goods to your customers, looking into the details of each may help you identify potential savings, therefore generating profit to your business. Also, there are many transactions that have multiple types of accounts. For instance, the money to repay a loan is split into 2 parts. One, to pay off the loan amount, which is a liability, and the other part to pay the interest, which is an expense. These 2 have to be accounted for separately. As you get set up and keep record of your accounts, keep the following in mind. Use clear and descriptive titles when creating your chart of accounts. Too many lines can clutter up your financial statement, so use sub-accounts instead and keep things more organized. I know this seems like a lot to remember, but you'll break through these accounting fundamentals. So, if you found this video helpful, hit that like button, and to find more videos like this one, be sure to subscribe to our channel. See you next time. Oh, thanks so much for watching this video. I hope you learned something new. If there's a specific video you'd like me to make, please put it in the comments below. Next, we've also created a learning syllabus so you have everything you need to successfully learn bookkeeping. It's down in the description below. And finally, if you want help starting and growing your accounting or bookkeeping business, click on the link in the description below to book a call with my partner, Bryce, to see if our mentorship program can help you reach your goals. See you next time.